Oak Business Consultant offers you another financial model projection template for rental property. It has been designed for you to forecast up to 60-month operating budget and cash flows with a relevant set of assumptions. So let's dive in. We will start with an assumption sheet which contains all the assumptions about the capital structure, revenue assumptions, OPEX, CAPEX, and working capital. Here, all the orange cells are those cells which can be changed as per the requirement of your business, and all other cells will be updated automatically. Let me show you how. If I'm changing this from 40 to 60, you can see the change in the monthly installment. Then we have the revenue assumptions starting from the occupancy rate. All these assumptions are to drive that what on average what will be the occupancy rate for every month. Then we have the property assumptions, that what type of properties we have and what are the number of units for each property. You are going to list down the average monthly rate for each property. Then we shows the growth in the rent. Then we have the COGS assumptions, that is the repairs and maintenance and property management. Then we have some other assumptions. We have also taken into account deposit assumption because deposits are one of the crucial part of the rental property businesses. Then we have the payroll. Here you can list down the employee position, select the department from this drop down, and then you can accordingly write the salary here, and you can select the joining month. Then we have the capex where you can know what fixed assets you are going to have, what is their purchase one, what is their asset life, and how you are going to sell them at what price. Then we have the operating expenses and working capital. Moving on, we have the revenue analysis, which is the detail about how you are going to earn your revenue. It starts with mentioning the available number of units that you are going to have. Then it goes on calculating the occupancy rate for every month. The occupancy rate is based on the units that are vacated, units that are rented, and the net occupied units. Then we have the units, occupied units for each type of property, so we can get the revenue from each type of property. And then we have the total revenue and the total cost of services. Then we have the financial statements, starting with income statement first, which shows the net income at the end, so one can know the profitability of his business. We can see the net profit and loss here. Then moving on, we have the cash flow statement, which has three sections. Net cash flows from operating activities, which are the inflows and outflows from the day-to-day activities from your primary business activities. Then we have the cash flow from investing activities, and then we have the cash flows from financing activities. At the end, we have this net cash flow. So one should know that what is the position of cash in the company and whether he is able to pay the bills or not. Then we have the statement of financial position, which shows the value of assets and liabilities and equity at a specific point of time. Here we have added this check so one can know that the balance sheet is balanced. Then we have the startup summary. It is a quick snapshot of the first year in which you will know that what is the total funding you will require and what are the total expenses, so you can know whether you need extra funding or not. Then we have the financial analysis starting with the break-even analysis. Here we have the point of the cells where the revenue equals to cost. Then we have the company valuation to know the worth of the company and whether it is profitable to invest or not. So we have the NPV and IRR as well. Then we have the sensitivity analysis in which we are showing the changes in the revenue and NPV and IRR if there is going to be change in the number of units occupied. Here we have the actual number of units, and if those number of units are decreasing by 10%, let's suppose here, then we can see the change in the revenue. If I'm changing this to 20%, you can see that the number of units have decreased and so has the revenue. Then we have the KPIs and the ratios. These are the multiple financial ratios which are helpful in assessing the financial health of the company. Then we have the working sheet, which shows the detailed calculation of the depreciation, loan amortization, working capital, and deposits. Then we have the dashboard at the end. It is a quick snapshot for your company which shows the different charts and the graphs. So this is all about this model. Thank you everyone for watching.